So today we'll be reviewing the May 2025 data as we continue to focus on any significant changes so far this year due to tariffs, inflation, or high interest rates. Oh, here's Ann. Hi, Ann.
Hi, I'm so sorry. What an issue I was having, but
Okay. I knew it
apologize
was
to everybody.
I knew it was something. So we
Awesome.
just okay. So we'll be looking at any changes. And with the launch of our risk migration webpage just 2 business days away, I have a couple of unique credit quality looks that I've pulled from one of the new charts. And a quick note, if you want more information on a specific topic, our contact information will be in the back. And as always, the analysis is my own. This is not meant to be investment advice. So the data that we're going to be looking at today comes through the Credit Risk Navigator. This is the longest commercial loan benchmarking service in the US, started in the third quarter of 2003. Here are some the glossary of our lending terms and definitions. I put these in here because I frequently mention them, but thought it would be better that you have them in here so you can go back and refer to them. So let's get moving. So here's C&I, and we're going to start with the non-performing and delinquency trend. Non-performing loans that are 90 days plus past due, 90 days past due plus non-accruals. That's in the red. The green is the short-term delinquencies. The blue is the 60 to 89 days or medium-term delinquencies. Short-term delinquencies, a little decline this month, which is sort of, if you track back to 2020, you can see it's gradually moving down. Herky-jerky, so to speak, but we're moving down that way. The 60 to 89 days, unfortunately, that's a big jump. It was 0.05, it's now 0.11, still kind of small, but we haven't seen a jump like this since around the COVID area. So we'll keep an eye on this. Could be just a one-term aberration or maybe something that is happening. We'll keep an eye on that. And then non-performing is really leveled off at the last couple of months, and actually dropped down a little bit. So let's look a little deeper at the non-performing though, because even though it's leveled off, we still have some issues. As we go through the non-performing detail, here by industry sector and later on by property type, I'm going to differentiate between pockets of issues versus more widespread or extensive problems. I'll mention as best as I can without violating the confidentiality rules we have here. If there's an industry or a property type that has problems in just a single state, or if those problems are being experienced from more than just a few banks, to kind of give you an idea of how pervasive the situation is, and give you a kind of a feel for the overall condition of the sector being discussed. So with this chart, we're showing the percent non-performing for each 2-digit NAICS industry sector as the column in the columns. The horizontal dotted line is the overall industry average. So any column that is above the line is performing worse than average. So let's touch on a couple. And again, as best I can, I'll let you know whether these are multitude of problems or a single problem. The first one on the far left, 11 Ag. We've talked about this one before. This is our tree nut farmer in California for one bank. So this is just a solo event for agriculture. The other agricultural data appears to be fine. Coming towards the right, 23 construction. We're seeing some issues here with the utility system construction. And it's a couple of banks, and it's in a couple of states. It's in Maine, Colorado, and Texas. So a little bit more pervasive than you'd say the tree nut farmer. All three manufacturings continue going to the right. It's interesting that the most recent Federal Reserve survey showed an industrial capacity utilization is down from 77.4 to 77.4 from 77.1. And as Jeremy mentions here, the ISM number is down as well. And so we're seeing some of those problems. For 31, the problems are mainly for soft drink and distillery manufacturers. Both are in Kentucky, and the bulk of this is for one bank. So this could probably be a single event. 32, the problems or the predominant problems are for printing manufacturers. Uh, Most of it in Michigan, but or Michigan's the biggest, but there's several other states that are showing non-performing too. And this is going through a couple of banks. And then 33 manufacturing, the predominant or the largest group of non-performing loans are for motor vehicle parts and motorcycle parts. The motor vehicle parts for companies in California, the motorcycle parts for companies in Wisconsin, and again, just a couple of banks or a few banks, not a lot. Further to the right, 45 retail. From the Commerce Department results, we know that May sales were down almost 1% from April. And here we're seeing some difficulties for pharmacies in Ohio and Pennsylvania, again, for a couple of banks. And then the last one I'll mention, the last big number you see there over on the right-hand side, 56 admin. This is for telephone answering service in Oklahoma, and the bulk of this is for one bank. So this is more like the 11 ag as opposed to what we were seeing with some of the manufacturing numbers. So now we'll move on to the credit quality numbers. And this is our new measure that we call emerging distress. A quick definition. Emerging distress is a credit quality measure that we developed and introduced last month. When a bank joins CRN, we map their borrower ratings to the RMA or the ProSight, now it's ProSight, 10-point scale. On that scale, ratings 1 through 6 are termed as being pass, with 6 being low pass. And 6 rated borrowers get that way because they are indications of a decline, usually a financial decline. Borrowers rated 7 through 10 are criticized, with 7 being special mention, which is primarily potential weakness and a deterioration in repayment prospects. For emerging distress that you see here, I've combined the low pass and the special mention and created a category of loans that are beginning to show some weaknesses. Most of these loans are not yet on non-accrual. That's why they're here. And if you had joined us before, my previous distress measure included substandard, doubtful, and loss. Most of those were on non-accrual. So these loans are still paying, but they're beginning to show some signs something's happening with these loans. And that's why we thought combining them would be a good indication of the credit quality of the overall portfolio. So this measure got close to 30% as a result of the COVID closures and restrictions in late 2020. Then it reached an all-time service low in January of 23 at 15.8%, but it spiked almost immediately after that on fears of inflation and then high interest rates. It's now sitting at 22.6%, and it's been in this range really since mid-2023. Let's take a look at some of the detail behind this. So here's the above the line chart again, the columns being the emerging distress for each individual NAICS code, the dotted line being the overall average. And when you get this data, you might want to do something that I do. I like to match this chart versus what we saw for the non-performance by industry chart. So I can compare credit quality or predicted quality versus current performance. And often you see these two are aligned. The worst industries here are the worst performing industries. But on occasion, you'll find a sector that's performing well, but has an elevated distress level. So kind of an early warning system, if you would. For example, an industry that's aligned is 45 retail. And 45 retail here, it's sporting goods, bookstores, general merchandise, things like that. It's one of the worst performers, and it has the highest emerging distress number. So it's matching up there exactly. Just to its left is what I would call a misaligned number, 45 retail. 44 retail, I'm sorry. This is automobiles, motor manufacturers, things like that. It's one of the best performers, but the emerging distress level is right on the average line, maybe a little bit above. So the forecast there would be, even though it's doing well, there's some potential problems there. And again, I would suggest that when you get the document that you take these two charts and put them side by side. and take a look at what if there are any things that are misaligned. So I'd mentioned starting out that on Monday we will be officially debuting our fourth webpage. It's called Risk Migration. I've been showing that a little bit. Here's one of the charts that will be on the webpage and a quick explanation of how this has been constructed. We're looking at borrowers that were in the database in December of 2023 and still in the database as of December 2024. We look at what the borrower risk rating was as of December 23 and then what it is as of December 24. And using the RMA 10-point scale, if the rating went from 1 through 6 or pass to 7 to 10 or criticize, that shows in the red. For the reverse, criticize to pass or getting better, that shows in the green. So what does this tell us? What's this saying to us? First, on a macro level, your eye, I think, just pops right away and you see how many reds here and how big the reds are. So that's telling you that the C&I portfolio is declining in credit quality, regardless of which industry you're looking at. And as a whole, it's gone down. You see a pronounced shift to criticized status for just about every industry. For some industry specifics, you can see that several individual industry sectors have had dramatic ratings drift, to the negative. Notably, right there in the middle are both transportations, 48 and 49. The others that have had dramatic shifts are 32 manufacturing and 44 retail, which we just talked about. And only 3 industries have had pass to criticize percentage of less than 2%. So those would be the 3 that you would say are performing or are being rated well. Those are the 21 mining, oil and gas, finance 52, which we'll talk about a little bit later, and then 92 public admin, which has historically been a great credit quality and a great performer. So here's a little more detail on 49 transportation. And what I did, let me go back a second. All I did was in the new database or the new workstation, you're able to hover on 49 and click, and this is what you get. So it gives you a little bit of a pie chart to show you where your pass to criticize is happening, what regions it's happening in. And you can see from here that about a third of the pass to criticize events occurred in the Southwest, maybe a little bit around a quarter, a little bit less in the South. So a lot of it in the southern part. And then the stat at the bottom, you see that nothing went from criticize to pass, nothing went into the pass category. 5% went pass to criticize. So with these sort of numbers, you get a feel for the drift, as I call it, and what's happening. Pardon me. And one last drill through. Again, this is for 49, some extra details. With the box on the left, you see the statistics. So you see that 22% of transportation and warehousing is in the criticized category. Nothing, and I'll go left to right and come on down. So nothing went from criticized to pass. 5% went from pass to criticize. And then overall, 6% got upgraded. So that would be regardless of what number, whether it's passed or criticized. And 11% got downgraded. So almost 2 to 1 in downgrades. And then the graph on the right side in the green there shows the percent criticized by state. So just a little bit more detail than what we showed with the pie chart. And you can begin to get a feel for where what states are having some significant problems. For instance, if you look at the top 3 there, Connecticut, Nebraska, and Vermont, at least 50% of their borrowers that are transportation and warehouse are rated as being criticized. So that would probably be an area that you need to take a look at. So now we'll move on to CRE, and I'm going to go through this slide quickly because every time I look at it, I get dizzy. I'm not sure how they took that. I assume it was a drone. So last month, we saw a big increase for residential. And that was almost entirely due to a huge increase in 90+ days delinquent for one bank. This month, that large delinquency appears to have been paid, and the residential's numbers have improved. So what's left? Um, but I jumped ahead. I'll move this here on the trend. So we began to show CRE separate in 2010, but in 2010 it was really bad, and so it was sort of distorting what you could see here. So what we've done now is start with 2021, so you can see what's happening recently. The 30 to 59 days in the green, that's sliding down again. You see the volatility with the short-term past dues. I try not to make much out of a month-to-month change on these. Uh, the 60 to 89 days is up substantially. I mentioned this because we saw the same thing with CNI. So I'm not sure if this is an issue. Um, is the market turning, or so this is something we're going to keep an eye on. I usually don't put much stock in this 30 to 59, but this 60 to 89 going up here and CNI gives me a little pause for concern. The non-performing drifting down towards 1.2%, and it appears to have stabilized. We were up a little bit in early 23, late 23, but it looks like we flattened out. But there's a lot of pieces behind this moving. So let me move into here. Again, I mentioned residential, and I apologize for jumping ahead. Residential is cleared out, and that was one bank's problem, and appears to have been solved. Office is the highest and has been holding at this level since the beginning of the year. And I'll make a note here. Every bank in the Credit Risk Navigator database has dollars that are non-performing for office. I can't say that for all these other property types. We can for office. So everybody has office problems. Probably not a new statement, but I thought it was worth mentioning. The next highest is mixed use, and that's limited to just a few banks. It's high, but it has been improving. Come over one more to the left, and you see lodging. It's high, but it's been heading up recently, just for a couple of banks, not for everybody, just a couple of banks, but it is moving back up after having been improved for such a long time. It was at 1.5% at the beginning of the year. It's now over 2%. And we're hearing a couple of factors that are working against lodging. First of all, the inflation has caused a drop in travel, primarily for pleasure, and that has impacted family and resort hotels. And then the overall economic uncertainty due to tariffs is impacting business travel in cities like New York, San Francisco, LA. The tariffs have also had a dramatic impact on foreign travel, and that's hit a lot of the hotels. And if you get the Wall Street Journal, you might have noticed on Monday, there was an article about hotels. LA, Los Angeles passed an ordinance that said hotel workers need to be paid $30 an hour as a minimum. And a lot of the hotels have basically said, we can't do that. And so there's some performance problems there. I'd also note that retail, while still below average, has ticked up over the first half of this year. And we're seeing non-performing loans for almost every bank. And as I mentioned earlier on, the Commerce Department has reported that sales are down versus the previous month. So this might be an area where we might see some problems in the near future. Now I'll move on to our emerging distress trend for CRE. Again, this is low pass and special mention. And this looks very similar to what we found with CNI. Starting on the far left in 2010 and coming to the right, you see the overall improvement in CRE quality up to 2020. Then the COVID activity pushed everything up to just under 35%. We came back down and we actually hit a service low in August of 2022. And then almost immediately, with the inflation and high interest rates, the level declined or accelerated. And we've been back in the 35% range for almost a year now. So let's take a look at some specific property types and what's happening. Again, I mentioned that I like to compare this chart with the performance chart to see what's misaligned. Good performance, poor quality, vice versa. And before I make comment about any specifics, I wanted to remind you of what we saw last time out with the CRE risk migration matrix. We saw a significant shift to the right or higher ratings. And from what I'm seeing in CRN, most banks are either holding CRE level outstandings level or decreasing the book. So the overall approach is one of extreme caution with CRE loans. The credit quality appears to be slipping, and the performance is maybe moderated, but there's still a lot of caution. So in terms of what's aligned, office is one of the worst, emerging distress is one of the worst performing, almost perfectly aligned. But if you come a little bit to the left, you see multifamily is the number 2 property type in terms of emerging distressed. And then further to the left, number 4 is industrial properties. These are 2 most misaligned property types we have. They're both performing well, but the outlook, if you would, or the emerging distress is high. So why? What's going on here? What we're hearing from the banks is that in most markets, there's a large number of apartment units coming online this year. And many or most of these are what they call Class A properties. So expensive to build and expensive to rent. And the question is, and why you see multifamily so high here, is can they be rented out to begin with? And then if they can be, at what price or what level of concessions are going to need to be made to get these properties occupied? And then how will that all impact the net operating income? Because the cost is so high, if the net income margin gets squeezed a little bit, the ability to pay out these loans is going to be questionable. Similar problem with industrial, problem with oversupply. The e-commerce growth spurt at the late 2020, early 21 has cooled or has slowed, and the need for warehouses has decreased. I was talking with somebody who was in the Midwest, and they said that they had several warehouses in their area that were vacant, that they were built specs and just never got filled. And in addition, we're hearing that the do-it-yourself craze, that housing craze has cooled, and that's impacted storage needs as well. So 2 areas in my mind, multifamily and industrial, kind of surprising given their performance, but what their credit quality outlook is. I'm going to finish up with another look at risk migration. And here we again have the pass to criticize and criticize to pass for CRE property types. The overall trend to criticize, so the move to the reds, is even more pronounced for CRE versus what we saw with C&I. The only property type that came close to having an equal amount go into criticize and come out of criticize was healthcare. There you see towards the right-hand side. Lodging had the most go into criticize, and we talked a little bit about lodging. And office and industrial also had 4-to-1 margins moving into the worst criticized category. So again, the migration of credit quality for CRE properties is sort of all over the every property type. It's not just office. You hear all the publicity is on office, but it's other things as well. Here's a little closer look at lodging. The largest percentage of moving into criticize was for the West. The Western Midwest is right behind. I'll let you know that there's not a lot of loans in the Western Midwest. So for this to be one of the largest categories is kind of telling. So that must mean a lot of deals in the Western Midwest are moving. And you see basically down at the bottom, 6% pass to criticize, 3 crit to pass, so a 2-to-1 movement. And then the last drill through, overall, if you look on the box on the upper left, directionally challenged today. 20% criticized, which means 1 out of every hotels on the books is in trouble. 18% downgrade, but 13% upgrade. So not all bad news, but in general, lodging is having some issues. So that's it for the May 2025 data. And again, thank you, those of you that stayed on the line, and I hope you found this interesting. I did want to let you know that we'll be back on July 31st with an all credit quality presentation. And we're going to be looking at the risk migration numbers that I have showed here. We're going to look at a live presentation of those numbers. So we'll take a look at all 6 charts and see what the June 24 versus June 25 numbers are saying. So if you're not on vacation, please join us. I think you'll be surprised to see some of the rating drifts, especially for some of the better rated borrowers. And Ann, I'll turn it back over to you to see if they have any questions.
Thank you. And again, I sincerely apologize for the delay, and thank you for those that did stay on. I will give it a moment to see if there are any questions. I don't see any in the Q&A currently.
Okay.
I will give it a second.
So again, I flashed up here our contact information, Ann, in case people think of something later on and want to get back with us.
Yep, sounds great. All right, so this will conclude this webinar. Thank you so much, Tom, as always, for your insights. Thank you, everyone, for your patience, for sticking on, and we look forward to seeing you again next month.
Thank you.